Has the world gone crazy? Should you be investing in gold? And if yes, how do you even do that? Well, yes, the world is always a little crazy, but we don't need to let it freak us out. And the answer to the other two, well, let's dig in. Welcome to Making Sense. It's the podcast for people who want financial freedom without giving up their coffee, and it's supported by our friends at Kiwi Bank. I'm Frances Cook, an independent financial journalist and fellow financial freedom seeker who makes money simple for you. Now today we're diving into a truly golden topic, and I mean that literally. Should you be investing in gold? I have been getting so many messages about this, about how it works, if it's the only safe place to be right now, why the price has been spiking. So of course, can't leave you hanging. Let's do this. Making Sense is on a mission to make money simple, and I just couldn't do that without the support of Kiwi Bank. It's really important to me to only work with companies that understand that mission and the difference it makes when you understand the money world. For Kiwi Bank, their purpose is to help Kiwi and Aotearoa be better off. So bringing you real stories of inspirational and unconventional approaches to finance is one of the ways they're making a real difference to the lives of their customers. This is making Kiwi better off. This is Kiwi. Now look, I'm not that surprised that I'm getting so many messages or that gold is running hot at the moment. The world has gone wonky, and that's when gold shines. Okay, I won't do too many of those, but I had to do one. Look, we've had plenty to worry about before the recent craziness. There was Ukraine and Gaza, even rising tension with China. There was plenty else happening in the financial world as well. But then the US bombed Iran's nuclear facilities and tension went through the roof, and gold prices took a bump as well. Now, why? Gold is quite a fear-based investment. When the experts say that, what they say instead is that it is a safe haven investment. And that just means people go for it when they're a bit scared. Basically, when markets go wobbly, wars break out, or inflation runs hot, gold often gets dragged into the conversation. So we've had plenty of that around the world recently, which has seen some investors turning to gold, which then pushes up the prices. And gold has hit record highs through 2024 and stayed quite strong into 2025. And as I mentioned, just in the last week, another little bump. So of course, that only fuels more people to look at it because now it's jumping in price and that always gets attention. But is that a reason to pile in now? Or is the party already over? We're going to break down some myths and then some realities of gold investing, when it works, when it doesn't, and how to turn it into your investment strategy, how to fit it into your investment strategy, I should say, in a smarter way. So, got a solid 4-parter here for you. Part 1, why gold gets so much attention. We're starting with the basics here. Why is gold a big deal in the investing world anyway? So gold has always had a bit of a reputation. It's been used as money or a store of value for literally thousands of years. It was money before we even really invented money. That sort of history makes people feel more comfortable with it. Unlike paper currency, it doesn't rely on a government to back it up. And you can't just print more of it. People like that. So when inflation starts to eat away at the value of regular money, gold ends up looking pretty attractive. Like I said, it's seen as a safe harbor during times of geopolitical chaos or economic crisis. And I don't know if we've seen many of those around recently. I mean, who could say? There's a reason that central banks keep stockpiles of it. They're not collecting jewelry for fun. Gold is an asset that tends to hold on to its value over time, and it's proven that over thousands of years. And more recently, gold has just kept hitting those headlines. Again, because of the high inflation, the uncertainty over interest rates, worries about wars or recessions. Any of those on their own can make investors a little bit nervous. Never mind when you've got multiples happening at once. And when investors get nervous, they often turn to gold. Now, gold is also different from other investments because it's not tied to the performance of any particular company or government or currency. You don't have to trust a CEO to make good decisions or a government to keep inflation in check. Gold just is, which can also be one of its drawbacks, but I'm coming back to that one. When economies get shaky, investors often rush to gold because it feels like something solid to cling to. And unlike most financial assets, gold isn't someone else's liability. If you own physical gold, you're not depending on someone else for a promise to pay. You own the thing outright. Again, fear based investment, all of that type of security, that's what people are looking for. And it's also relatively scarce. While we can print more money, we can issue more shares, you can build more houses. You can't just create gold out of thin air. It has to be mined, it has to be refined, it has to be processed. There's only a certain amount in the ground, and it can be hard to get to. So that scarcity adds to its appeal, particularly when people are worried about the value of regular fiat currency. So the emotional sides that I've mentioned, that counts a lot. In uncertain times, investors want safety. Gold taps into this deep-rooted belief that it's something of lasting value. And whether that belief is always rational is a different story, but that's definitely incredibly powerful, and it's one of the big driving forces behind gold. All right then, part 2, when gold works and when it doesn't. Despite all of this history and mystique, gold isn't magic. There are times when it performs really well, and there are times when it seriously disappoints, and all of the gold hypers tend to avoid talking about that. So let's start talking about inflation. You know inflation? We've all had a bit of an experience about it recently. It's the cost of living and how everything costs more over time. Sometimes a lot more, as we have seen recently. Gold is often seen as an inflation hedge, aka when the price of everything is going up, gold's price usually goes up by even more. Usually, not every time. You look back over history, and when the cost of living goes crazy, then shares, bonds, property, your other classic investments, they often struggle to keep up in high inflation times. Look, they do brilliantly over a period of several years. You know that I'm a devoted shares girl. But in the midst of that real crunchy time, they might not be doing as well right then, at that exact moment in time. And if you're also struggling at that exact moment in time, those investments aren't going to be able to help you right then and there. Meanwhile, gold often has done well in those times and kept ahead of the inflation. But that's only partly true, and it doesn't work every time. It can have some wild price swings. Between 2011 to 2015, gold prices dropped more than 40%, and it took until 2019 to break even again, which is a really long time if you'd bought at the peak. And I think people often forget those drops when they talk about it being this safe haven. The price can definitely fall too. Don't jump in to the gold hypers who say it's the only safe place to be. Which brings me to the timing issue, because everyone sends me these messages about whether they should be investing into gold when the gold prices are in the news. And when gold prices hit the news for being high, well, it might be too late. A lot of people pile in just when the price is peaking, and it's classic FOMO. Remember when gold hit those record highs in 2011 and then that big drop? And it went into that huge slump. It's nearly a decade. And if you'd bought at the top of that, ouch. It can be tough to wait years to just break even. And Everyone will say with hindsight that you could see the signs that it was a bubble, that it was going to pop. Nobody says that at the time. Everyone's a genius in hindsight. You don't see them ahead of time. They all come out of the woodwork after. Another thing I want you to think about is the income side of things. Now, look, gold goes up and down in value, can do very well in being worth more. But the value of it is different from it creating income. Value increase or decrease, great. Love that for you, but you have to sell it. If you just hold it, you're going to get nada until you're ready to sell. Does it create anything? Does it have any sort of income? No. You sell it or you don't. And if you're not selling it, it just sits there, looking at you, being pretty and shiny. That's it. There's no interest. There's no dividends. Now, when interest rates are low, this doesn't really matter as much, doesn't really tend to bother people as much. But if interest rates go up again, a lot of people can end up feeling that it's a bit of a bummer and that they may be missing out. Now, does that mean it's a bad investment? No. You've just got to be smart, and you just need to know the downsides as well as all the hype. People love to tell you the hype and just gloss over those downsides. Plenty of hype around. So let's just be sure that you've seen that dark side too, and it's all part of your plan. Part 3, how to actually invest in gold. If you're still interested, let's look at your options. Life looks different for everyone. Maybe you're buying your first home, growing your whānau, dreaming of travel, or simply trying to stay on top of things. KiwiBank has the tools to help you manage your money your way. Find out more at kiwibank.co.nz. This is making Kiwi better off. This is Kiwi. Option 1. This is what most people think of: physical gold. This means buying gold bars or coins or jewelry. The coins are actually kind of cool. They have designs and different ones for different countries. They're quite fun. A lot of people tend to go for the coins because the bars are a big investment. If you get a gold bar, that's a lot of gold. That's a lot of money. The coins might be a bit more achievable in between. And yeah, they look really cool. Look, physical gold is the old school route, and it has a certain appeal, right? You physically own it. There's no counterparty risk. There's no reliance on financial systems. But there are downsides. You're going to need secure storage. And by that, I mean, start thinking vaults or safety deposit boxes. If you're doing that, please go with a specialist company that you have very carefully checked out. Do not cheap out here, people. Some people do tend to store it at their own homes. If you do this, do not tell people that that is what you are doing. You need a proper safe, bolt it to the floor, and do not tell people what's in there. Do not tattoo "rob me please" on your forehead. And then there are some other side issues with physical gold. There's things like insurance. You'll also have to deal with markups when you're buying and selling. And depending on what you buy, resale can be tricky. That all costs more money. All of those little things I've just mentioned, those can eat into your returns. Jewelry in particular. I know I mentioned jewelry as a way to buy physical gold. Often not a great investment though. Save it for if you really know what you're doing. You're paying a premium for design and craftsmanship, and the resale value usually doesn't cover that. You should also be aware the second-hand physical gold market is an absolute Wild West, and you should only really venture there if you're really confident in your skills. People might try to dilute gold to sell you less while still charging you top dollar. There are also just flat-out fakes. So stick to the mainstream credentialed sellers. Places like the National Mint, if you've got one of those in your country. Pawn shops not a great idea. All right, option 2, gold ETFs, ETCs, and managed funds. Now, this is the modern route. These are exchange traded funds that track the price of gold. And you might also see alongside the ETFs some ETCs. Now, stick with me here. These are very similar to the exchange traded funds, but they're exchange traded commodities. They're still traded on a stock exchange like the funds. They give you the chance to invest into a single commodity like precious metals, such as gold. Some are backed by physical gold held in vaults. Others use derivatives to mirror gold prices. Now, look, the pros, same as any other ETF. Low fees, easy to buy and sell, no need for a safe or insurance. You can invest through the regular online platforms that everyone uses to invest in things like shares, just like you would any other ETF. It is super simple if you go for something like this. But there are cons, and some of it speaks directly to that fear-based investing that leads people to gold in the first place. The cons, you don't physically own that gold. And in extreme scenarios, I'm thinking total financial collapse, look, that might matter. Though for most people, I would say that's not so much of a concern. But for some people, it is. For some people, that's why they want to be into gold in the first place. Option 3, gold mining shares. There are companies that dig gold out of the ground, and investing in them means you're exposed to gold prices, but also to the company's specific risks like management, operational costs, debt levels, and all the rest of it. Now, what happens when we add more risk in? We get the possibility of higher returns. The possibility. These tend to have more price jumps than gold itself. In other words, they're more volatile, more ups and downs. But that does mean they can also have more growth potential. If gold prices go up and the company is well run, you're stacking your wins on top of each other. Profits can soar. And you can also invest through mining-focused ETFs to spread the risk across multiple companies. This one is a little to the side of the core gold debate, but it's a popular one. It's an interesting one, so I'm putting it out there. It's one of your options. All right, the meaty bit. Part 4. Should you invest into gold? Now look, this is where we get real. And I also once again remind you that this is not individual financial advice. I know we also have that disclaimer on every episode, but we're just putting it back in here. This is a walkthrough of how things work, generally speaking. Here's what I think the average person should consider when they're thinking about whether gold is right for them or not. Look, gold is not a get-rich-quick scheme. It is not a core growth asset. But it can be a useful hedge in your portfolio. So I've talked to a lot of financial advisors about this one, sort of testing what everyone is up to. A number that lots of them land on when they're talking to their clients who are interested in gold is somewhere between that 5 to 10% of your investing money into gold. And it can give you that lovely little diversification, aka don't put all your eggs in one basket. The price of gold does tend to do different things at different times. When you're looking at things like shares and property, it moves differently to those. So it can help smooth out your investing journey over time. I just don't think it's essential. If you're starting out with investing, for a lot of people, it makes more sense to focus on building a solid base with your classics, shares, bonds, index funds. Those will usually give you more consistent growth over the long term. Gold makes more sense for people who already have a fairly big, well-balanced portfolio and they want a bit of extra insurance. It's like adding airbags to your investing car. You hope you never need them, but you might be glad they're there if things get a little bit bumpy. Now, look, it also depends a bit on your worldview if you want to get into gold or not. If you are worried about currency devaluation, geopolitical instability, or you think there's a really long-term market correction coming, things going down for years, then gold might help you sleep better at night. Some people, and this is the extreme end of things, but it exists. Some people genuinely want gold because they fear the world is about to fall apart. Now, look, I'm personally of the perspective that humans are big old cockroaches. We keep surviving things that we probably shouldn't. But if you're genuinely worried about the apocalypse, financial or otherwise, you do you, boo. I know that's a part of the gold buying community. That's cool. To each their own. Just keep it in perspective. Gold is not a cure-all. It doesn't always perform well in inflation. It's not great for things like income. And if you're chasing big growth, you're probably better off looking at things like shares, stocks, property. So here's where we're at. I know we've talked about a lot. I'm going to wrap it up for you. Bottom line, all money is emotional. That's a given. But gold, definitely an emotional investment as much as it's a financial one. And it's often a fear-based emotion. It tends to have price spikes at times when the world is a bit mad because it's driven by fear, by distrust in the systems, and in the hopes of investing into more security, a safe haven. That doesn't make it bad. That's not necessarily a criticism. Sometimes there's plenty to be fearful about. It just means you need to be honest with yourself about why you want it. If you want to buy gold because you think it'll go up next week, might not be a great move. But if you want to have it as a way to balance out some of your other investments, it's a little insurance clause, build an investing portfolio that can weather different types of economic storms, then sure, gold might have a place for you. Just don't bet the house on it. You use it as one tool among many. All right, team, that's it for this episode of Making Sense. If you found it helpful, send it to a friend who's curious about gold or just really into shiny things. Until next time, have a great day.
Just a note before you go. This podcast can only give you general information about how things work in most cases. It's not individual financial advice. We're all different, so some of this might not apply to your specific situation. Take what works for you, ignore the rest. If you're after individual financial advice, a financial advisor is always the best bet.